Welcome back, investors. Jake here. After the dramatic drop in the US stock market on Friday, we've got to make an update video talking about it. And here is the one-day performance on Finviz.com, the heat map showing the S&P 500. And this is pretty brutal. Nvidia in one day was down 9%, Google was down 5.4%, Amazon down 4.7%, Apple down 3.7, Microsoft down 3.8. When we zoom out and look at the 1 week performance, it doesn't get much better. The only sector in the green for the S&P for the week was energy. And when we look at the charts on Yahoo Finance, you could see that we were building a nice new uptrend with the share price of the S&P 500 consistently staying above the 20-day moving average. But as soon as we hit the 200-day moving average, we started seeing resistance. There was a small sell-off before the huge drop on Friday. The S&P on Friday was down 3.37%. And the rally that we had over the summer was pretty phenomenal. The S&P 500 from its low on June 17th up until August 16th was up 17.4%. The NASDAQ was up over 20% from its low, so that's the technical definition of a bull market. However, perhaps this was just a bull trap and a true bear market. When we zoom out and look at the 1 year performance, the S&P is still down 10%, and the market really peaked on January 3rd or January 4th. So the obvious answer of what caused the market to sell off on Friday was Federal Chairman Jerome Powell opened his mouth, and Powell warned of some pain ahead as the Fed continues to bring down inflation. So initially I saw the articles, I saw the sell-off in the market, and my first thought was it's an overreaction that Fed Chairman Jerome Powell said something minor and traders just jumped on that to short the market. And then I actually watched the entire 10-minute speech. It's not very long. I'll link it down below. If you're a long-term buy and hold investor, feel free to ignore this temporary blip in the market, keep holding. But if you're a short-term trader or you're holding on to cash, wondering if you should buy into this market, you might get some better prices as the market might continue to drop in the short term. And I recommend watching this 10-minute speech Powell gave at Jackson Hole, Wyoming, and I'm going to go through the highlights with you because this was pretty dramatic from the language that he's been using the last 2 years as we navigated through COVID. This is a stark, U-turn in direction. No more transitory inflation, no more soft landing potential. He's talking about true pain coming for the U.S. economy. So let's go through the highlights together watching this clip.
Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses.
For a Fed chairman, this is as dramatic as a language as you will get from him, using terms like forcefully, below-trend growth, softening of the labor market conditions, and some pain. Wow.
These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain.
So his argument for getting tough now is saying if we don't do something about runaway inflation today, it's only going to get worse 6 months from now, a year from now, as prices on everything continue to spiral out of control. So let's skip ahead here to 244, hit play.
The labor market is particularly strong, but it is clearly out of balance, with demand for workers substantially exceeding the supply of available workers. Inflation is running well above 2%, and high inflation has continued to spread through the economy. While the lower inflation readings for July are certainly welcome, a single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down.
So this is what he's referring to. Inflation peaked, you could argue, in June of 22. We got the June inflation numbers in July showing it peaked at 9%. The next month was then better. The July numbers reported in August came in at 8.52. This is what more or less led to the last rally over the last 2 months for the US stock market, investors being excited that inflation had peaked, it was coming down. Wall Street was already talking about interest rate cuts coming next year and the United States economy booming once again. And Powell's basically throwing cold water on that fire, saying, hold on, don't put the carriage in front of the horse, or whatever that expression is. Let's skip ahead to 540.
It is true that the current high inflation is a global phenomenon, and that many economies around the world face inflation as high or higher than seen here in the United States. It's also true, in my view, that the current high inflation in the United States is the product of strong demand and constrained supply, and that the Fed's tools work principally on aggregate demand. None of this diminishes the Federal Reserve's responsibility to carry out our assigned task of achieving price stability. There is clearly a job to do in moderating demand to better align with supply. We are committed to doing that job.
So the Federal Reserve's mandate is twofold. One is full employment, the other is price stability. We're basically at full employment, so the Fed has to get to work on price stability, which means bringing down inflation. And unfortunately, there's nothing the Federal Reserve can do to increase supply. The two factors on economic forces are supply and demand. Supply has been constrained due to changing demographics, shutdowns in China, the reduction of Russian energy and raw commodity exports. So the Fed can't do anything about supply. The only thing they can do is on the demand side. Raising interest rates will kill global consumer demand as it becomes more expensive to borrow money, more expensive to do anything.
The second lesson is that the public's expectations about future inflation can play an important role in setting the path of inflation over time. Today, by many measures, longer-term inflation expectations appear to remain well anchored. That is broadly true of surveys of households, businesses and forecasters, and of market-based measures as well. But that is not grounds for complacency, with inflation having run well above our goal for some time. If the public expects that inflation will remain low and stable over time, then, absent major shocks, it likely will. Unfortunately, the same is true of expectations of high and volatile inflation. During the 1970s, as inflation climbed, the anticipation of high inflation became entrenched in the economic decision-making of businesses and households. The more inflation rose, the more people came to expect it to remain high, and they built that belief into wage and price decisions.
This is really important. What Powell is saying is that people just believing that inflation is high will lead to higher inflation. When you're setting prices for your products and services and you think everyone else in town is also raising their prices because inflation is high, then you're going to do it as well, even if your bottom line, it's not required as much anymore. Supply costs and labor costs are what drives a business to increase their prices. But I feel it. I feel it when I go to the grocery store today. A single guy shopping for one, I tend to find that my grocery bill is now closer to about $60 whenever I go, whereas 2 years ago, it was closer to the $40 range. So inflation for each individual purchase, it's not as noticeable, but as soon as you start filling up a cart, filling up a basket, you start to notice the bigger picture. So we have a serious global problem. This is not just an American problem. There's high inflation in Canada, high inflation in the UK, high inflation across Europe. And the United States, being the world's largest economy, has to lead. And they have to do this by raising interest rates. And I'm making the argument that I think central bankers around the world are talking to each other, and at least in the West, they're all on the same page. There's nothing that the Bank of England can do to get global inflation under control by just raising their interest rates. It's really crucial that the United States also does it in conjunction with all of these other banks like South Korea, Australia, Switzerland. So the federal funds rate is currently close to about 2.25 or 2.5. This hasn't updated. And Powell is signaling that aggressive rate increases are coming. Maybe 75 basis points again, just in a couple weeks when the Fed meets in September. And they're going to keep raising until inflation is under 2%. And I really feel like from the language he's using in this speech, he's subcommunicating that the enthusiasm and the optimism on Wall Street for the US economy has to be broken. There has to be a capitulation point at which companies say we have to scale back on operations, we have to scale back on hiring. People have to think that revenue and sales are going to drop next year in order for revenue and sales to drop next year. It's kind of a chicken and the egg argument. And the primary driving force for inflation, the price of energy, the price of raw commodities have all been coming down since June. That's fantastic. But something we don't have a solution for is the unemployment rates. And the unemployment rate is currently at 3.5%. I've made the argument that it's getting really bad in America for a couple of reasons. One is changing demographics. As the baby boomers retire, labor force participation is just dropping. But the other one is that everyone's hiring. If you think people have money and they will buy more of your goods and services, you want to hire more workers in order to increase your cash flow. But when there's a tight labor market like we're experiencing today, you have to keep increasing the amount of money you're willing to pay your workers in order to hire them and retain them. And what I'm about to say in this video might be one of the most controversial things I've ever said on this channel, but I think that the low unemployment rates in America today is threatening national security. I'm going to make the argument. I know in the comments section I'm going to get a flurry of controversial answers to this. And here's an article from NBC News. Every branch of the military is struggling to make its 2022 recruitment goals. And there's lots of theories why the military is struggling to meet their recruitment goals. But the primary one is the unemployment rates. If you can make $20 an hour stocking shelves at Walmart's, you're less inclined to join the Army or join the Marines. The United States military had no problem recruiting when the unemployment rate in 2009 was closer to 10%. So lawmakers press the Pentagon for answers as military recruitment crisis deepens. Lawmakers from both parties of the aisle have expressed worries as the grim recruiting numbers continue to circulate throughout the DoD and Congress. Let me read this one paragraph for you. Multiple lawmakers from both sides of the aisle have expressed similar worries in recent days as the grim recruiting numbers continue to circulate throughout the DoD and Congress. The Army has reached 66% of its goal for the fiscal year ending in September. The Navy's at 89%, according to data compiled in between October 2021, May 2022. Even with rates of 100% for the Marines, Air Force, and Space Force, that leaves department-wide a rate of just 85%. And given everything that's happening in the world relating to geopolitics, I'm not exaggerating when I say this can be the lead up to World War III that is occurring. With Russia invading their neighbors, China saber-rattling, demanding control of the South China Sea and Taiwan. This is not a good time to be failing to meet our recruitment numbers for the United States military. And I know the response is, Jake, why don't you just pay them more? we can go ahead and look at the monthly basic pay table for U.S. service members. You come in at basic training for whatever branch as an E1. By the time you graduate tech school, more than likely you're going to be at an E2. So, cash in your pockets, what are you making as a service member 6 months into your enlistment? Maybe you're still in tech school depending on the length, but ideally you've started your job by now. And cash in the bank, your take-home pay is $2,054 a month. This is a lot better than the conscripts and draftees get in Russia, China, and North Korea. But people in Western countries will look at this dollar amount and say it's not good enough. The problem with the benefits you receive in the United States military is this $2,000 doesn't tell the whole story. If you're living on base, you're getting housing for free, you're getting free food at the DFAC, you're getting healthcare coverage, you're getting TSP 401k matching, you're getting the GI Bill, you're getting all the benefits that come with being a veteran once you get out. I would argue that serving in the United States military for 4 years and having a clean record and an honorable discharge is more valuable to you economically than a 4-year liberal arts degree bachelor's, which I have both. So it's not about the number. Yes, you can make more money working at Walmart in your hometown to spend on partying and cars and your personal hobbies, but as far as lifetime benefits, it's no contest what the United States military offers. And I'm rambling at this point, but where I want to go with this is I believe that members of the federal government, members of Congress, have been talking to Fed Chairman Jerome Powell, and they've told him that this is now a national security issue. The fact that the United States military cannot meet their recruitment numbers, given that the economy is doing so well. Still, the economy is overheating, unemployment is at historic lows. I think at some level, even though this is not the Fed chairman's job, I do believe he has to take into account national security and the fact that we are experiencing a more dangerous world between Russia and China right now. And if they don't get the unemployment rate to go back up just a little bit, there's so many factors at play here. This is actually really fascinating. But I just personally wouldn't be surprised if someone from the Pentagon met with Fed Chairman Jerome Powell and said, you got to do something. You got to help us out here. This historic low unemployment rate, which is causing the inflation, is also hurting the United States military, hurting their national security requirements. This is going to be a controversial thing that I just said. I know I'm going to get some attention for this. Now, I know people have been asking me in the comments section, am I still holding those 21 put contracts on the NASDAQ? Here's a screenshot from my account from Friday, and when the NASDAQ goes down 4%, this is what happens to all of your put contracts. They all go up 100, 150, 170%. Unfortunately, they had already gone down 90%, so that's not as impressive of an increase. But these put contracts don't expire for another 3 weeks, September 16th. So I'm still alive, and I'm still in the game with my active trading account with Charles Schwab, for those of you who have been following my channel for a while now. And when we look at the charts on TradingView, this is pretty fascinating. There is a shorter term uptrend for the NASDAQ at least, so I would expect next week to be red, but maybe this uptrend line can hold. Otherwise, I think the market is going to give up all of its gains that it's made the last couple weeks, and potentially the QQQ, which is what I've shorted, that could drop back down to 290 or 280. Maybe a sideways consolidation range will clearly form, and we're not in a new uptrend, but just a maybe a wider, broader downtrend, you could argue. Last chart I want to quickly share with you guys, because everything falls or rises with Apple. I didn't catch it, I didn't see it, but look at this incredible trend line with 3 points of contact. We're going to go ahead and make this the same red. And I wasn't even looking for it. I didn't even see it. Other charters spotted it, and you could see 3 points of contact as Apple was on this insane bull run going straight up nonstop for 6 or 7 weeks. It hits this slope, this downtrend before selling off again, and then, as you can see on Friday, put up a huge red candle. I wouldn't be shocked if Apple continued to sell off at least until a nice round number like 150. It might find support there. So I think the S&P, the QQQ, will also sell off if Apple is selling off back to 150. So I might sell to close all my contracts for whatever I can get for them as soon as Apple gets close to 150, because I think Apple might experience support at that level. Additionally, the VIX spiked. The VIX goes into option premiums contracts, and on Friday it jumped up 17%. That is partly what is contributing to all of my put contracts going up so much in one day. So if the VIX can continue to spike and maybe get back to the 34, 35 range, I might also consider selling everything to close for whatever I can get out of them, but not making excuses. Terrible trade, mistimed it, lost a bunch of money. I've already been very honest with you guys in previous videos. Alright, that's all for this update video. If you found it interesting, give me a thumbs up. Any hot takes on what I've said in this video, let me know down below. I love hearing from you guys. Till the next video, take care.